Your E-2 visa application can be perfect in every way. Right industry, substantial investment, proper ownership structure, and still get denied because your accounting doesn't prove your business is non-marginal. Consular officers look for 7 specific accounting artifacts, and most E-2 applicants have no idea what they are. I'm going to walk you through the 7 artifacts consular officers want to see and how to read your P&L like an adjudicator and how to structure your books to support E-2 approval. I'm John Conrad with Numeratus. We're a white glove accounting firm specializing in E-2 and EB-5 visa compliance. Everything you can imagine a big firm doesn't want to touch, like complex business structures for visa holders, non-marginal profitability requirements, and renewal documentation. That's exactly what we do here. We've worked with over a dozen E-2 visa holders, helping them structure their accounting to meet consular requirements, prepare for renewal interviews, and maintain compliance throughout their visa period. What does non-marginal actually mean? Let me explain what consular officers mean by non-marginal, because this is where most E-2 applicants fail. The legal standard is that a marginal enterprise is one that does not have the present or future capacity to generate more than enough income to provide a minimal living for the treaty investor and their family. So what does this mean in practice? Your business must generate significantly more income than just covering your personal living expenses. Consular officers want to see either substantial profit beyond personal needs, or significant job creation for U.S. workers, or clear trajectory towards substantial economic impact. But why does this matter? If your business makes $200,000 in revenue, but your profit is only $40,000, that's barely enough to support a family. Consular officers might consider it marginal, even though you're technically profitable. For example, an E-2 applicant operates a consulting business. Revenue is $180,000 a year. After expenses, the profit is $35,000. The consular officer looks at this and thinks, this business barely provides a minimum living for the applicant. It's marginal, and their application is denied. Another E-2 applicant operates a similar consulting business. Revenue is $250,000 a year. After expenses, profit is $120,000. And they employ 2 full-time U.S. workers. The consular officer sees substantial profit and job creation. This is clearly non-marginal, and the application is approved. Consular officers review your case looking for specific financial documentation. Here's what they want: clean, professional financial statements. Your P&L and balance sheet should be professionally prepared, clearly organized, and easy to read. Handwritten spreadsheets or poorly formatted statements raise red flags. Number 2, consistent monthly bookkeeping. Officers want to see that you have been maintaining books consistently, not just scrambling to create financial statements for the visa application. Number 3, that you have payroll records if you have employees. If you're claiming job creation, you need payroll records proving you pay U.S. workers. You need pay stubs, tax filings like 941s, and state employment records. You need business bank statements. These should match your financial statements. Officers look for discrepancies between what you report and what actually flowed through your accounts. Number 5, tax returns, business and personal. Your business tax returns, such as 1120, 1120S, or 1065s, should match your financial statements. Your personal tax returns should show income consistent with your business profitability. Number 6, profit and loss by month. Not just annual totals. Officers want to see monthly P&Ls to verify the business is operating consistently, not just having one good month before the application. And number 7 is financial projections for new businesses. If your business is new, you need realistic financial projections showing the path to non-marginal profitability. For example, an E-2 applicant submits beautiful, paired financial statements showing strong profitability, but when the consular officer requests bank statements, they don't match. The business claims $300,000 in revenue, but only $150,000 flowed through the bank account. This is a red flag, and they get denied for fraud suspicion. Another E-2 applicant submits consistent monthly P&Ls, bank statements that match payroll records for 3 employees, and tax returns that align with everything else. The documentation tells a coherent, consistent story. Their application is approved. By the way, we help E-2 applicants prepare all these artifacts at Numeratus. We ensure your accounting tells the right story and everything aligns. But let's get back into it. How do you read your P&L like a consular officer? Consular officers aren't accountants, but they know what to look for. Here's how they read your P&L. They look at profit margins. If your revenue is $200,000 and your profit is $30,000, that is a 15% margin. They're thinking, is this sustainable? Is it sustainable? If your revenue is $200,000 and your profit is $90,000, that is a 45% margin. They're thinking, this business is healthy and generates substantial income. They look at expense ratios. If your rent is $5,000 a month on $15,000 a month revenue, they're concerned about sustainability. If your payroll, including yours, is 70% of revenue, they're concerned about whether there's enough profit left over. They also look for red flags. Personal expenses disguised as business expenses. That would be like family and vacations, personal vehicle expenses, groceries. Excessive owner compensation that leaves little actual profit. Inconsistent monthly performance. One great month, then there's a month where there's nothing. Declining revenue trends. For example, a consular officer reviews an E-2 applicant's P&L. Revenue is $240,000 a year, so that's $20,000 a month consistently. Cost of goods sold is $60,000 a year, about 25% of revenue. Operating expenses, about $90,000, and this includes rent, utilities, marketing expenses. They have payroll for 2 employees, and that's $40,000 a year. They have owner compensation, which is $30,000 a year. Their net profit after revenue and all those expenses are netted together is a net profit of $20,000. The owner is taking $30,000 plus $20,000 worth of profit, which equals $50,000 in total, plus employing 2 people. This is what they consider borderline. If the business is in a high cost of living area, they might consider $50,000 marginal for a family. But if projections show growth to $300,000 of revenue and $80,000 of profit within 2 years, they might approve based on the trajectory of your projections and where you're actually going. Another officer might review a different application where revenue is $400,000 a year. Operating expenses are $180,000 a year. Payroll for 5 employees is $120,000 a year. Owner compensation, $60,000 a year. The net profit after everything's netted together, $40,000. They see that the owner is taking $100,000 total and creating 5 U.S. jobs. This is clearly non-marginal, and they approve the application. So what's the job creation alternative when profit isn't enough? If your personal income from the business is borderline, or what we call marginal, job creation becomes critical. So what's the job creation path? Consular officers consider a business non-marginal if it creates significant economic impact through employment, even if owner income is modest. So what counts? Full-time U.S. workers, not contractors. Permanent positions that are not seasonal or temporary. W-2 employees with proper payroll taxes. Evidence of ongoing employment, not just hired right before the application. So what's the magic number? There's no official threshold, but generally 2 to 3 full-time U.S. employees demonstrate economic impact. 5+ employees is very strong. For example, an E-2 applicant operates a restaurant. Revenue is $600,000 a year. After all expenses, the owner's profit is $55,000 a year. If the officer looks only at owner income, this might be considered marginal. $55,000 isn't a lot in many cities, but the business employs 8 full-time U.S. workers, cooks, servers, managers. Total payroll is $280,000 a year. The officer sees, yes, owner income is modest, but this business is creating significant employment for U.S. workers. This has substantial economic impact, and it's approved. Another E-2 applicant operates an online consulting business. Revenue is about $150,000 a year. The owner takes $60,000, has 0 employees, and it's just the owner really who's running the business. The officer sees this is essentially self-employment, no job creation, owner income is modest. This looks marginal, and they're likely denied unless they are strong growth projections. let's talk about renewal requirements. Maintaining non-marginal status. Getting approved initially is one thing. Renewals require proving you've maintained non-marginal status. So what consular officers look for at a renewal? They want to see revenue growth. Is the business growing or declining? They want to see consistent profitability. Have you been profitable through the visa period? They want to see job maintenance and creation. Have you maintained or increased employment? They want to see tax compliance. Have you filed all required tax returns? They want to see business stability. Is the business sustainable long-term? For example, an E-2 holder applies for renewal after 2 years. At initial application, the revenue is $200,000 a year, profit $60,000 a year. They have 2 employees. At renewal, revenue is $180,000 a year. Profit is $40,000 a year, and they only have 1 employee. The officer sees that the business is declining. Profitability is dropping. They lost an employee. This raises concerns about viability. Renewal might be denied or require additional documentation. Another E-2 holder applies for renewal. At the initial application, the revenue was $200,000, profit $60,000, 2 employees. At renewal, $280,000 of revenue, profit $95,000, they have 4 employees. The officer sees strong growth, increased profitability, and doubled employment. This business is thriving. Renewal approved immediately. And what is the documentation that you need? Complete financial statements for every year of the visa period. Tax returns, business and personal, for every year. Current bank statements. Updated payroll records. Narrative explaining business performance and future plans. The key is maintaining consistent, documented success throughout your visa period, not just scrambling before renewal. Let's get to the final point. What are common E-2 accounting mistakes? Let me be clear about mistakes that get E-2 applications denied. Mistake number 1, mixing personal and business finances. Using your business account for personal expenses or vice versa makes your financial statements unreliable and raises fraud concerns. Mistake number 2, inconsistent record keeping. Having perfect books for the 3 months before your application, but nothing before that, makes officers suspicious. Mistake number 3, overinflating owner compensation. Paying yourself $150,000 on $200,000 worth of revenue leaves only $50,000 for all other expenses. This looks unsustainable and potentially fraudulent. Mistake number 4, under-documenting employees. Claiming you employ people but having no payroll records, no 941s, no W-2s. Officers will verify employment claims. Mistake number 5, unrealistic projections. Projecting you'll grow from $100,000 to $1 million in 1 year with no explanation of how. Officers know what's realistic and what growth really looks like. Mistake number 6, not planning for renewal. Treating E-2 as one and done instead of maintaining compliant accounting throughout the whole visa period. For example, an E-2 applicant submits financial statements showing $300,000 of revenue and $100,000 of profit. Looks great. But their bank statements show only $180,000 flowing through. Their business tax return shows $150,000 worth of revenue. 3 different numbers. That's a red flag and most likely a denial. Or an E-2 applicant claims they employ 4 people, but submit no payroll records, no tax filings, no evidence of employment. The officer requests documentation. The applicant can't provide it because the employees were contractors or didn't exist. They were denied for material misrepresentation, potentially banned from future applications. E-2 visa approval depends heavily on your accounting, telling the right story. Clean books, professional statements, documented job creation, and consistent profitability. These are what consular officers are looking for. And yes, I've been talking about consular officers this whole video, but really we're talking about immigration officers here in the United States. They're one and the same thing. This video showed you what consular officers want to see and how to structure your accounting correctly before and after. The bridge to preparing your accounting for E-2 approval is where Numeratus comes in. If you want to stay informed about E-2 visa requirements, accounting best practices, and renewal strategies, join the Numeratus community at numeratus.org for $100 a month. We break down visa compliance requirements and keep you updated on policy changes. If you need a more hands-on approach, if you're preparing an E-2 application or renewal, if you need your accounting structure to demonstrate non-marginal status, if you want professional guidance, ensuring your financial statements tell the right story, book a consultation at Numeratus.us. We specialize in E-2 visa accounting compliance. That sounds interesting to you? Book a call.